welcome to this special broadcast called MC Pro Stock of the Day with me, Stacey Pereira. In this segment, we bring you some fundamentally strong stock ideas that you could consider in your portfolio. Well, today we have for you a household name, that is ZEE Entertainment. A little bit about the company. It can be recalled as India's original broadcasting pioneer, and it is poised to become the largest broadcasting network once the merger with Culver Max or Sony is complete. And the combined entity will have 70 to 75 channels, including 10 sports channels and 2 OTT platforms. ZEEL's own India TV network share, which stands at 17.9%, and it can then command nearly 35 to 40% of the market post the merger. So what exactly are the growth drivers? Well, it does hold a dominant position, especially post the merger, which has already received those required approvals. And with all the approvals in place, the merger can be closed as soon as next week. Like mentioned earlier, the merged company will have about 70 channels and about 30 to 36% of its India network share. Better still, the two established OTTs, that is a Sony Live, which includes the sports as well as general entertainment or GEC channels, as well as ZEE5, which is mostly the non-sports content. Together, they have 40 million subscribers. Moreover, there are the early signs of ad revenue recovery, which are now actually visible. FMCG ad spends has returned, especially led by HUL. And even though rural spend has been quite tepid, this year around, it is expected to improve in the coming election season. And if you look at inflation, that too is now returning to RBI's comfort range, which in turn could result in improvement in those discretionary spends. Turning focus then to the good show by ZEE Studios so far. The return of mass entertainment has pretty much brought back the crowds to cinemas, which is likely to continue in the second half of FY24 as well. ZEE Studios production aids its linear TV as well as OTT platforms. And if you are someone who needs the backing of numbers, take a look at the company's Q2 FY24 performance. It has been pretty strong, which is led by the movie business. In fact, the EBITDA too has improved sequentially to 13.6%. ZEE5's losses have also come down, while the revenues have grown by 36.8% on a QOQ basis. The company is also expecting its subscription revenue to grow and to in fact get a boost from early FY25 onwards, as content costs in fact still remain elevated. Looking at the company's valuation, now the stock is trading at FY25 price to earnings of 23.2 times, and the stock can be added on corrections. But are there any kind of risks that you should be watching out for? Well, the slower advertisement revenue recovery as well as any delay in that merger completion should actually be on your radar. Well, with that, it's a wrap. Thanks so much for watching.